Let's track where the money is going. For the week ended Feb 15th, investment-grade bonds saw inflows of $1 billion, high-yield outflows of nearly $3 billion. Munis, meantime, saw inflows to the tune of about $300 million, and these have all had a pretty strong start to the year after a dismal 2022. What will the next move bring? Let's bring in Nisha Patel. She's managing director and portfolio manager at Parametric. Nisha, the message seems to be, in a way, even while it's risk on for stocks, are we starting to see risk off in the bond landscape?
Yeah, so I think it's important to note that this past January, from a performance standpoint, was extremely strong, right? Munis came roaring back, second best January of performance, and that was really a result of a lot of money that had left the market last year coming in, given very higher yields, absolute yields, and cheaper valuations. Now we're just this week starting to see a little bit of a correction in the market. Obviously, Treasury rates, to your point, as you mentioned earlier, have moved another leg up pretty significantly after last week's jobs number, a lot more optimistic data being priced in. Munis are finally catching up. So muni yields have gone up about 25 or 30 basis points in just this week.
Wow.
So I do think that over the next few weeks, we're anticipating actually the flows to actually slightly turn negative. And with the combination of higher supply being anticipated in the market, it could put a little bit of further pressure. Now, that's a little bit of pain for existing investors, but I think the opportunity really comes in for cash, right, investors. A lot of clients have been waiting for the right opportunity to leg into the market. Mm-hmm. We think it's coming up soon. And just to provide context of yields, we're looking at about 4% tax-free yields in the 15-year part of the curve, which is almost 6.5% taxable equivalent.
Exactly. No, and it's interesting because it felt like almost prior to this week, people were saying, yeah, munis, you can't get any value there anymore, and yes, yields are down so much. And to your point, now, literally just this week, they've jumped again. I mean, we know state and local, we know muni, we know all the economics are strong for now. I worry a little bit in a couple of years after the potential downturn, and by the time it catches up. But where do you think is the most value for people who say, okay, that is a pretty juicy return, but I don't want to get into something I'm going to regret in a couple of years' time?
Yeah, look, I think high yield spreads had certainly widened out. I would say they're attractive in the short end part of the curve particularly. But I think given just the sell-off that we've experienced this week, there's no reason to take on credit risk, right, if investors don't feel comfortable. The bottom line is that municipalities in general, to your point, are in extremely strong standing, right? It's important to mention that most states are going into, let's just say, this upcoming recession or slowdown, whatever you may call it, with almost 2 times the amount of liquidity that they were going into the pandemic with, and 3 times as much as they were going into the financial crisis with. A lot of these states are sitting on a lot of the federal aid that's been unused from the pandemic funds that they received, almost 20% sitting there. So, yes, there will be further likely kind of drops in revenues. States and cities are balancing kind of as they always have been, right, making the appropriate cuts. But I think the liquidity situation certainly works in their favor. But I think the investment grade space, again, is offering a lot of opportunity now that clients don't have to take on additional risk. Right,
exactly. That's what I mean. You do see that even with the muni fund flows, maybe it's partly the attractiveness of the yields, but I do wonder if people are also going, what, maybe I'd rather be here for the next leg down, if there's going to be a leg down here.
Yeah, exactly. And look, here's kind of the biggest thing that we're always coming across also in this environment, right? You take a look at 1-year Treasury yields, 2-year Treasury yields on the short end, right? Very attractive. There's no doubt about it. So clients, and especially high tax clients, are wondering, well, if I can get 4.6, 4.7 in a short end Treasury, does it make any sense for me to kind of go into another market? And I want to stay high quality. We're kind of using this opportunity to say, look, munis are very high quality. Right, you're finding very strong AAA, AA rated bonds. And now with this significant kind of backup in yields, you're able to lock in for a longer period of time those very attractive kind of 6.5% taxable equivalent yields, right? We're not even accounting for state taxes there. Then you start looking at almost a 7 to 7.5% for New York and California investors, where things, to be honest, start getting pretty juicy.
Yeah. Nisha, thank you so much. It's good to see you again. Thanks for joining us today.
Good to see you, Kelly.
Nisha Patel.
All right, take care.